Welcome to Eurodollar University Conversations with our good friend, Steve Van Metre. I think the big topic, well, there's a couple big topics this week. Number one, probably the pound, the gilt market, an operation by the Bank of England, some kind of liken it to QE. It's not really QE, but is it really not QE? We'll find out. Let's talk to Steve about that before we get into other things like inflation. Where is consumer prices going? Where does the market think consumer prices are going? And does the market think consumer prices are going in a direction that is going to lead to more operations like the Bank of England? Are we going to see more QEs down the road? Is this Bank of England gilt rescue merely the first in a long line of rather predictable outcomes? Because let's face it, I think this is always going to be where we were going to end up anyway. So Steve, what do you think? The pound, the gilts, are we guilty about gilts?
Jeff, thanks for having me back. I like to say that higher interest rates are all fun and games until somebody gets hurt. And, we think about QE, we think about what's going on in Great Britain and with the interest rate market, gilts, we see their currency going down. And why does this really matter is because the market is betting against the Fed. We see this almost every time where the central banks say, we're going to raise rates, and the market's almost like, all right, well, how much pain can you handle? And then the central bankers turn and say, well, we'll see how much pain you can handle. And then, of course, we have this game of chicken where they're both running at each other. This time, now we see in the UK pension market, and of all things, all of a sudden pension funds who buy bonds with the notion that they're going to hold them to maturity are starting to get margin called and have to liquidate at a loss. I mean, that's just not how it should work.
Yeah, that's not the pension funds in particular. It's not that they're speculating in the bond market. In many ways, they like bonds because they're safe and they offer them the kind of protection that pension funds require, their mandates, but also they're mandated to buy these things, right? The governments say, you need to own these things and you need to own a lot of them. And so the pension funds are sitting there thinking, you told us we had to buy these things and now you're destroying the market for them.
Yeah, and what does the Bank of England come out and say? Okay, you know what? You're under stress. You're getting margin called on. So our solution, which is brilliant that they don't even understand that they need these pension funds, like you said, mandate them to hold and own them, which again, the pension funds are more than happy to do, is they say, hey, look, we're going to run a temporary, which I'm sure we'll agree that this is anything but temporary, operation of buying long-dated gilts.
It's temporary in the same way Japan's QE was temporary, and that was 21 years ago.
Yeah, well, I mean,
it's temporary.
It's temporary. You know what, Jeff? I'm going to call the word out here. It's transitory, even if it's at 21 years. But what I love about this is that the Bank of England thinks that the pension funds are actually going to sell them when in fact they aren't going to end up selling them. What's going to happen is when this temporary period expires, I think it was 2 weeks, that they're going to do it, we're going to have the same problem back again. If they even cancel it, my bet, Jeff, I don't think they stop.
No, it reminds me of the repo problems that showed up in September of 2019. Again, the Fed had no idea what was going on. They just knew something was wrong. And so what did they do? They implemented these temporary repo operations that weren't really repo operations, but that's not the point. These temporary repo operations that here we are 3 years later are still around. They're still there. There's temporary programs to fix a problem that nobody really can define what the problem is. I think in the case of England, in the UK and the gilt market, it's not really about the gilt market so much as it is about the lack of liquidity that we see pounding the pound. The bigger problem behind a lot of these things is the fact that the dollar system has experienced an enormous spasm. Another one, the third one so far this year. And that's creating all sorts of issues. I always use the quote from our friends in India who said, these dollar crises tend to create economic drags on economic growth and financial instability. And what did we see in Britain of all places, in London of all places? We see problems with economic growth. The UK said, we're in recession and it's going to be bad. and in financial instability. Those two things go hand in hand when you run into dollar issues. So the point here is that, yes, we can look and we can point at the gilt market, and we can talk about British pensions and the problems they're in, but we're really looking in a mirror here. We're not looking just at Britain, right? We're looking at a much bigger issue.
Yeah, absolutely. Because at this point, if you're looking at the dollar saying, and maybe you're trading the dollar, investing the dollar, you go like, well, there's no way this can go higher because, I'm going to look for an opportunity to short it. The really issue here I look at is what could stop the dollar? I mean, there's really nothing going on other than bringing the Fed back into play for the moment. They appear to be, dug into their position of we're going to continue to do quantitative tightening. We're going to raise some more rates. Although I have a hunch that by November, something probably is going to change. Maybe you agree with me on that, Jeff. But right now I look at the dollar, I said, what's going to stop this thing from going even higher?
Yeah, I think that's the point here is that, we were always scheduled or slated to get into a situation which would lead to more quantitative easing. Not that it makes a difference one way or the other, because quantitative easing, certainly in my mind, Steve, is quantitative easing is central bankers recognizing that things are going wrong and then doing what they do to try to tell the public they're doing something about it. So the issue is when you see quantitative easing, it's about something going wrong, right? And that's what we see. Again, that's why to me, what happened with the Bank of England this week was more like quantitative easing than not, because the Bank of England saw, hey, this thing just broke and I gotta get on the news. I gotta get on the internet and tell people I did something about it. Doesn't matter what they do, but the correlation there is when a central bank does something, it's because something has gone wrong. More has gone wrong than has gone right. And when you put these two things together, more going wrong than going right leads us down the road to eventually, as you said, Steve, more QEs are coming. Not just because of gilt markets or bond markets, but because the wider system is showing us signs of deflation. And we'll get into some actual inflationary estimates in a minute. But also, everybody can feel the recession. You can feel it coming. I just likened it to the phony war at the start of World War II, where the Germans invaded Poland, France and England declared war on Germany, but then for 8 months they just kind of looked at each other and did nothing because the German army needed to regroup after Poland. But so World War II had begun, but everybody knew, all the troops were lined up, everybody was ready to go. We could see it happening, but it took a while for it to start. And it kind of feels like, to me, that's where we are in the markets and the economy. We can all see it, we can all feel it. Even got a little bit, the Bank of England and QEs are coming, but it just hasn't quite started just yet. At least not the full stuff, the big stuff.
Yeah, I think that's a great point you make, Jeff, about the fact that when QE comes back, it doesn't mean things are good. Because one thing I hear from investors all the time is like, man, I'm bulled up, I'm buying because the Fed's going to capitulate, they're going to be back with QE and stocks are going to just go straight up. And it's like, wait a minute, you don't understand. The global economy is slowing. If you think that QE is all this magical pill, it's not going to fix this inventory issue. It's not going to cause new orders to go down because we have too much inventory, which we heard this week. Another one, Nike, comes out and says that they got tons of shoes and stuff that they don't know what to do with. So that's not
unexpectedly.
Yeah. And even worse, they said, by the way, we have actually more coming, which I think you have said very clearly. It's not just the inventory they have on hand, it's the inventory they still have yet to come.
Yeah.
And that's all going to start hitting, the earnings. And we'll see it here as earnings season is getting kicked off. We'll see it next quarter, and it's all going to filter through the economy. So the idea that suddenly the Fed shows back up and does QE is, the economy is like a gigantic ocean-going ship. Even if you shut the engines off and try to put them in reverse, the thing's going to go for miles before it even comes to a stop. Same thing happens here. I think you're right. By the time the Fed or all the central bankers come back with QE, it's bad news, because you told me before the show the signs of inflation are already pointing to disinflation.
Well, let's talk about that. Because we got a bunch of consumer price numbers this week. There was Germany, there was Europe as a whole, and then the PCE deflated in the US. Germany was huge acceleration in consumer prices, double digit CPI, double digit HICP. Then the next day, I think it was Friday, Europe came out, Eurostat said the same thing, double digit, record high, not just record high, but record acceleration. But even that, you sort of shake your head and like, well, yeah, but that's not economics. That's politics. That's energy. That's all the stuff that's wrong. Food prices accelerated. Of course they did, because all of the issues with Ukraine, Eastern Europe, Russia, all that stuff, energy prices, fertilizer, that has nothing to do with the economy. But then, okay, but wait, the US PCE deflator, the core rate, that unexpectedly accelerated to almost 0.6%. So there's still an inflation problem in the US, right? So maybe Europe it's got their energy and politics, but what about the US, Steve?
Right. And that's, I think, what everyone's looking at right now is, when is this going to cool off? When is the Fed even going to pause? Because you start looking at the economic data. One thing I like to show my audience on my channel is we look at the Philly Fed new orders diffusion index. And what's notable is it's very rare, and I know you know this, that when we see the new orders collapsing, that the Fed hasn't capitulated. At this point, it's like they're just got that throttle jammed at the max, and these numbers are telling them, nah, you haven't done enough, keep tightening. And at this rate, the question only is, to me, is when do we see an outright collapse in consumer prices? Is there something that's telling us that that's coming?
Yes, Steve, there is something that can tell us about what at least what the market is thinking inflation is likely to do, or consumer prices are likely to do, the direction they're taking. But before we get to that, we're going to conclude our conversation right here. We'll pick up in part 2 of it a little bit later. But first, we have to thank, as always, the members who support Eurodollar University. Got to let people know, Steve, about what you and I are doing together. You can check us out at eurodollar.university, subscriptions, bunch of stuff there. You can also go directly to marketsinsiderpro.com, which is live now for purchasing of subscriptions. But information for everything that Steve and I are doing together, as well as things I'm doing at Eurodollar University, just check us out at eurodollar.university. And as I said before, thank you to all our members, and stick around for the second part of our conversation.